네, 가상자산과 관련된 이슈까지 체크를 하고 돌아왔습니다. 이번 시간은 월가 트레이더 버니의 미국 주식 시간인데요. 미국 주식에 좀 투자를 하는 서학 개미분들도 많은 것으로 알고 있습니다. 최근 또 테슬라의 실적과 관련돼서 부정적으로 나올 것이다라는 이야기들이 나오면서 서학 개미분들도 힘든 시간을 보내고 계시리라 생각이 좀 드는데요. 더불어서 미국 시장에 대해서는 기술적으로 지금 현재 시장을 어떻게 분석할 수 있는지 그 내용에 대해서 오늘 준비를 해주셨다고 하니까 바로 알아보도록 하겠습니다. 함께 보시죠.
Well, let's look at where we've been over the last couple of weeks and try and identify what's going on in the market and seeing how things are starting to set up. We've looked at this chart before, which is the percentage of NASDAQ stocks above their 200-day moving average. And when we've gotten down here before in 2009, in 2011, in 2016, in 2019, and 2020, this is the COVID bottom, and now we're back down here. We're at about 10%. So we have conditions similar right now to where we've been over the course of all these market bottoms. We had an initial bottom in January, the end of January, then we bounced up, and then we came back down now. We bounced up after the first Fed rate hike. If we look at what's happened to these stocks that have sold off, particularly in technology and the high growth stocks, we can see from Microsoft down, okay, Microsoft's down 25.5%, Tesla's down 38%, Amazon's down 40%, we keep going down, Disney down 43%, Facebook down almost 50%, okay, and we keep going, Lucid down 68%, Etsy down 70%, you know, Chewy down 71%, Netflix down 73%, Roblox down 76%. These are significant declines that we've seen all the way down. Unity Software down 80%, Fiverr down 85%, and all the way down to Upstart down 90%. So what we've seen is a massive sell-off. And why has this occurred? This has occurred because a lot of these growth stocks are looking at, the market's looking at forward earnings, and they're anticipating, okay, what are the earnings going to be out 3 to 5 years? And when we've had interest rates go up, these forward earnings estimates have been notched down. And so what the market has done is brought these stocks down, so when they have forward earnings that are now in line more with a new 3 to 5 year forecast, these stocks prices are going to reflect that reality as opposed to the previous levels of 3 to 5 year earnings growth. We've talked about this before, and I've showed this chart before. This is what happens to the S&P after 6 consecutive down weeks. As of now, we're down a 7th consecutive week, so I can update this chart. But if we look at, generally speaking, what happens, and we go out over time, in 63 days, the market's typically higher. In 126 days, the market's typically higher. And in a year from now, the market's typically higher. And the average movement up occurs basically from day 63 through day 126 and into day 252. So from after one quarter into the second quarter and after 1 year. Now, what I want to show here is the magnitude and the duration of how hard this market has sold off and how much the market's already repriced stock earnings growth, stock pricing from there. So if we look at here, the number of days it took to reach down 40% was 388 days in the 2000 to 2002 sell-off. So 40% over a year and a half. In 2008, it was 238 days to go down 47%. So this is almost a year to go down 47%. We've gone down 33% in only 120 days. It's not quite as fast as we had at the COVID bottom, but that was a whole different story. But we've gone down much faster per day than we've done over these two periods of time before. So what we've done is we've repriced the market so quickly down over this period of time. Now, we're down basically 7 straight weeks, okay? So what we have is, this is current NASDAQ, a weekly chart, okay? Going back to the top of the market in November, then we have the sell-off going into late January, early February. This is where Warren Buffett bought all his stocks, 41 billion, and then we rallied back up after the March rate hike, and now we're down 7 straight weeks. Okay, so let's try and identify what happened. Initial sell-off, rally, down 7 straight weeks. Let's go back to 2000 to 2002. Initial sell-off, a rally, and then 1, 2, 3, 4, 5, 6, 7, 8 straight weeks down, okay, on a weekly basis for the NASDAQ. Now, if we go back and across right here, yes, we went down a little bit more, but we basically didn't have the magnitude of the decline stopped, okay? And then from here, we had a tremendous rally. If we look at NASDAQ in 2008, we had that same initial sell-off, then a little bounce, and then down 1, 2, 3, 4, 5, 6, 7, 8 weeks again. And from 8 weeks, we only spent about 3 months, maybe 4 months down there, basing around, and then we had a substantial rally. So what we have, and these are the only 2 periods of time going back to 1945 that we had 8 straight weeks, and we've got 7 now. So if we go down next week, that'll be 8, and that'll match this one, and right here, and that will match the other one that we just looked at right here. So something to consider is that the bulk of our declines are probably, to some extent, done. If we go lower now, I think we're going to grind lower. I don't think we're going to have a major capitulation on the way down. And the reason I think so is that more than 45% of the stocks are down 50%, okay, in the NASDAQ composite. More than 22% of the stocks, this is the yellow line, are down 75%, and more than 5% of the stocks are down 90%. The only 2 times that we had significant levels that were like this were 2000 and 2008, the periods of time where we had those 8 straight weeks of decline. We're up here in a pretty substantial way, but I think we could see a little bit more of an erosion. And how that erosion is going to happen, I think, is we're going to take the top off of some of the stocks that have already rallied, like Walmart had been up, energy prices, energy stocks were up, banking stocks were up. And now what we're going to see is we're going to see those stocks that were doing so great. We can't have, in my opinion, sectors that people can hide in and do really great and have other sectors go down in a market that's sold off like this. We've got to take the top off and set some of those stocks back down to normality, and some of them will go down 50%. So when we look at stuff like this, this is the new lows, okay, new 52-week lows in orange, and the new 52-week new highs in blue. And we can see we're down really low in the new 52-week highs. That's understandable. And we're up here at significant levels. We're going to know how exhaustive this is soon. And I think that all of these times that we hit these numbers down here were buying opportunities during this period of time. So the other thing we're looking at is that how many of these stocks are making new lows, and where are they? Well, the large caps are making more 6-month new lows. The mid caps are making more 6-month new lows. The small caps are making more 6-month new lows. And all stocks in general are making more 6-month new lows, which is, I want to say it's good, but it's how markets bottom. So when we look at the number of new lows that are expanding, the number of new stocks, because of all these sectors We can't hide in a sector. We need to see expansion of new lows. So ignoring sectors and looking at basically market capitalization, we can see the number of large cap stocks are making more new lows. That's good. The number of mid caps are making more new lows. These are identifications of tradable bottoms. The number of small caps are making more new lows, and all stocks in general are making more new lows. This allows the market and the investors to not be able to hide in certain sectors, like the banking sector, like the consumer staples sector, like the energy sector. Bottoms don't get made when some sectors are making new highs and other sectors are making new lows. We have to be able to get the whole market to flush out at the same time.